Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. Today is Friday, September 19th, 2008. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 4:30 p.m. in London, 12:30 in Bermuda, and 9:30 a.m. in Mexico City. You need to reach us during the broadcast. Phone in toll-free at 1-866-67-CATEX. Overseas, our instant mail address on AOL is CATEX-TV. On this day in history, 13 years ago in 1985, the Mexico City area was struck by the first of two devastating earthquakes that ultimately did claim over 6,000 lives. And we have two breaking stories. There's been another rail incident in Los Angeles. A light rail train slammed into a bus near downtown LA during this morning's commute, injuring at least 13 people. The Metro Blue Line train was headed to Long Beach carrying passengers. The bus fortunately was out of service. There were no passengers on board. The impact knocked the front car of the light rail train off the track. The other cars remained on the track. Of course, this comes just a week after the train crash that killed 25 people about 30 miles away from the scene of today's accident. Second story is stock market related. The American Dow Jones Industrial Average is up about 345 points. In Russia, Russian stocks rallied as much as 26% today, causing the Russian market regulator to stop trading once again on the two main stock exchanges. You'll recall that for the past 2 days they have suspended trading because of decreases in value. So today they automatically cut it off when it exceeded 20%. So I don't know if it's, well, obviously it's very late there in the evening. So now to our main news. As you probably know, the U.S. Treasury and the Federal Reserve began discussions late last night with congressional leaders on what could become the biggest bailout in U.S. history. Details remain to be worked out. The plan, however, is likely to authorize the U.S. government to buy distressed mortgages at deep discounts from banks and other institutions. The proposal could result in the most direct commitment of taxpayer funds so far in the financial crisis. Senior aides and lawmakers said the goal was to complete the legislation and have it to the president for signature by the end of next week when Congress adjourns. The Treasury this morning, in an additional move, agreed to offer temporary insurance for money market funds, of course attempting to restore confidence in one of the important safe haven investments. This is coming as federal officials are working on the overall broad plan. Money market funds, of course, had not been guaranteed. Only FDIC bank deposits have been guaranteed. In recent days, however, with Putnam, for example, the problems in the global financial system has pushed the value of some funds below the $1 level, causing them to so-called break the buck. With $3.5 trillion resting in such funds, a run against them could prove catastrophic. So the Treasury announced this morning it was dipping into a Depression-era account to offer insurance for the money markets, similar to the cash insurance offered by the FDIC. The insurance fund is limited to $50 billion and meant to be available for only 1 year. In addition, funds that participate will have to pay a fee. This would potentially undercut the slim returns that those funds already earn. Also this morning, the Securities and Exchange Commission issued a temporary ban on short sales of some 799 financial stocks, a move against traders who have sought to profit from the financial crisis by betting against bank shares. I'm sure Richard Fuld, wherever he is today, is upset at this timing. The temporary ban is intended to bring calm to the markets. This follows a similar action we'll discuss in a second taken in Britain last night. The SEC said that the emergency temporary action would protect the integrity of the securities market. Short selling is a bet that a stock price will decline, is the practice of selling stock without owning it, hoping to buy it later at a lower price and thus make a profit. It's often been blamed for forcing prices down in times of market stress. This was one of Mr. Fuld's pet peeves. The SEC and the New York State Attorney General's office has promised to intensify their respective investigations into short selling abuses. According to Andrew Cuomo, the New York AG, they are like looters after a hurricane. If you pass a rumor in a normal marketplace, people are calm, they check it out, they do their due diligence. when in this market, in this frenzied state, if you pass the rumor, when people are on pins and needles, the false information is much more impactful. Last night in London, the UK government stunned the city financial area when it banned short selling of bank shares by speculators. This was hours after a pledge by British Prime Minister Gordon Brown to tackle the deepening global credit crunch with a cleanup of the financial markets. Amid concerns that the officially brokered marriage between Lloyd's TSB and HBOS could fall victim to the controversial practice of driving down a company's share price, the FSA said it was prohibiting the active creation or increase of short positions in financial companies for 90 days, for 3 months. Short selling has inspired government action because ministers are relying on Lloyd's purchase of HBOS to revive the housing market. The Chancellor of the Exchequer, Alistair Darling, told the Guardian newspaper last night that the events of the last 13 months, culminating in the collapse this week of Lehman Brothers and the takeover of Merrill Lynch, have made the case for improved regulation unanswerable. Darling said it was right to waive competition rules to allow the Lloyd's and HBOS merger. He said if this hadn't gone through, competition would have been an academic problem. HBOS wouldn't make it through the week. Why is that a problem? Here's the story. Lloyd's Bank has bought rival HBOS to create a $50 billion U.S. mortgage company. This is after the Halifax Bank of Scotland shares plummeted significantly. The takeover marks another dramatic change in global financial market. HBOS is Britain's biggest home lender. It lost more than 66% of its value in 6 days beginning September 9th. The British government smoothed out any competition concerns about the tie-up between Lloyd's, which is Britain's 5th largest bank, and HBOS, which is ranked 6th, on the grounds that the merger would in fact promote financial stability. This will be a gigantic bank, so it's a big move for them. Back at the ranch here, the new CEO of AIG, Edward Liddy, has told AIG employees that AIG will still exist despite fears that the company will be broken up after it came to an $85 billion deal with the U.S. government late Tuesday night. According to Liddy, he's reported to have told senior staff, "We will not break AIG up into a million pieces and sell it off. Don't believe everything you read. There still will be an AIG." He added that the deal with the Federal Reserve Bank is, quote, yet to be fully inked, and added that he is not going to need 100 days to come up with plans for the stricken insurer's resurrection. I guess he'll do it sooner. However, he conceded that there would be a sell-off. Quote, "We will sell things that don't belong as part of AIG," he said. Liddy, of course, was brought in to replace Robert Willemstad. One senior executive present at the meeting said he was unbelievably positive and believable. In some other AIG-related news, the president and CEO of their reinsurance arm, Transatlantic Re, has written to clients and brokers in a bid to address any concerns over the plight of its majority owner. AIG owns 60% of Transatlantic Re. Robert Orlick, the TRC CEO, penned a letter on the 16th saying that although Transatlantic was a number of AIG units, it's important to understand that our parent company is an independent publicly traded company. He said further that the downgrade by AM Best from A+ to A had negative implications were due to the rating agency feeling that the need to harmonize all AIG's ratings, and Transatlantic was unfortunately swept into that category. He said that Transatlantic, which is the world's 8th largest reinsurer, remains in discussions with Best to sever that rating. He went on to say, "While we have no way of knowing what the outcome of any future meetings will be after we've received the full hearing, Bests indicate to us that they believe that our fundamentals and balance sheet are very strong." Finally, as expected, we have seen the first shareholder derivative suit. A U.S. pension fund is suing AIG. This is according to some reports. The City of New Orleans Employees Retirement System is believed to have filed the first shareholder suit against the company since its bailout. Apparently, they made a filing in the Delaware Chancery Court yesterday. They accused AIG of mismanagement and grossly imprudent risk-taking